Welcome to Explore Accounting. For today's lesson, we will be looking at the trial balance. The trial balance. This is a very important phase or process in accounting. You always have to go through the trial balance before you can be able to tell the story of what has happened in a business in the past month, in the past year, or whatever. So we will start with what the meaning of a trial balance is. Trial balance. Trial balance. It's very easy. As usual, you don't have to cram anything as usual, okay? Very easy. Just look at it. Trial is from the word try. Try your balance. You want to try the balances before you go ahead and prepare your final accounts or before you prepare your financial report. So the trial balance is just a statement that you prepare to test the accuracy of all the postings that you have made in the ledger account or that you have made in your journal, your general journal. That's what the trial balance is. It's not an account, but it is a statement that you use to test how accurate all these accounts have been after posting into the cash account, capital account, bank account, sales account. Then you want to check, have I made an error in the course of applying my double entry principle or not? Then the trial balance will give you the answer. So we say the trial balance is a statement that lists all the account balances drawn from the ledger accounts and which seeks to test the arithmetic accuracy of all the postings made into them. So that's what it is all about, the trial balance. Unlike most accounts or almost every account that we have, this has two sides, the debit side and the credit side. So we already have a list of transactions on the right hand side of the board to prepare these ledger accounts and also finally extract a trial balance to test and see if the postings in these ledger accounts have been correct. Okay, I want to believe that the postings will not take us time. If you're watching this channel for the first time, I would like to advise you to go see our other videos, especially the earlier videos, lesson 1, 2, 3, that talks extensively on the application of the secret of hair peel for the purpose of postal entries. Now look at it. We are dealing with trial balance here, and once more, we are still going to be relying on that little secret, hair peel. Don't forget, hair peel. On the debit side, you have hair, on the credit side, you have peel. So debit side here is expenses, assets, and receipts. All must be debited. Then, on the credit side, what have you got? You have P, which is payment, incomes, and liability. So let us get started already. Transaction 1, capital in cash. It means you started your business with a cash of $1,000. So we have always said that anytime you start a business with a sum or with a resource or an asset, that is to be classified as capital. So here we have capital, so the posting is going into the capital account, and we also have cash, which is going into the cash account. Now, I'm going to tell you this very quickly. I always like to start with cash account. Why? Because there is no way you can run a business without having a cash account. So it's always key. You have a cash account. And if you look at the board very closely, you discover that the cash account is bigger than the other accounts. Why? Simple. It's because there will be always many cash transactions in the business, and you don't want to be opening different cash accounts. So it's going to be one cash account and the central one, a big cash account. So any transaction that involves receipt of cash or payment of cash goes into this. That's why it's usually a bigger account. And I will also advise you to start your postings with a cash account. It's a lot easier than wanting to work the other way around. So let us see what happened in the transaction 1. Capital in cash, $1,000. Capital in cash, $1,000. What is happening there? 2 entries as usual. From every transaction, we get to create 2 entries in accounting or in the business generally. So what has happened there is there was capital introduced to the business, 1, and 2, there was a receipt of cash by the business. It is the business that is receiving $1,000 cash from the owner. So where is your receipt? This is the receipt, debit. The rule says debit receipt. That's it, the model. So you come here and say receipt. I received money into the cash account. You have it on the debit side. You say $1,000. Okay? And that is coming from where? Say capital account or equity. Same thing. Now, the double entry principle always says that for every debit entry, there must be a corresponding credit entry and vice versa. So, in this case now, we already have a debit entry, 1,000. We have to have a corresponding credit entry, which will show in the capital account. 1,000, that's coming from where? Coming from cash. Very simple. Debit, credit. So alternatively, you can say that capital is an extension of liability in the business because capital is what the business is owing the owner. So the rule says liability should always be credited. Don't forget that you have an extension here in the form of equity. So your equity is always credited. Can we go to the second transaction already? That one says cash purchases $5,000. Now once more, you see that cash is involved, so it's coming to the cash account. But let's look at it very carefully. Cash purchases. What were the things that happened? 2 things happened. Number 1 is that you make purchases, which is an expense. Okay? Expense. Then 2, you paid cash in the process, which is a payment. So you can choose which one you want to start with. So there we have a payment from the cash account. And secondly, we have a purchase, which is an expense. So the posting will go into the purchase account and also the cash account. They let us determine the debit and the credit entries. I think this is very clear. Look at the cash purchases there. From the cash account, you are making a payment, and your model, you have PE, payment, incomes, and the what? And the liability. So payment will be on the credit side of the paying account, which is cash account. The cash account is making a payment. We'll have it on the credit side, and that will be $500. You make payment for purchases. Simple. Easy does it. Now from there, we already have a credit entry here in the cash account. So there will now be a corresponding debit entry, and where? In the purchases account. 500 coming from cash. Simple. Very simple. Okay? Very, very simple. Very simple. That's, what do you call that? That's cash account. Very simple. Or you might want to say, since purchase is an expense, what does the rule say about expense? The rule says that expense must always be debited. Can you see? Expense must always be debited. Okay. So for that reason, purchase is an expense account. It will be debited. Oh, sorry. Let me turn on the AC. Sorry. Okay. Okay. So we're done with two transactions. Let's go to transaction 3. Transaction 3 is credit purchases from Ben, $800. Look at that very well, please. Credit purchases from Ben, how much? $800. The first thing you have to understand here is that I told you in my earlier videos that any credit transaction means a transaction where there is no flow of cash. Nobody is paying cash and nobody is receiving cash. You bought the goods, you got it on credit, you are yet to make that payment. You will make the payment in the future. So if there was no cash flow in that transaction, that means the transaction has no connection with this cash account. The cash account is simply a cash flow account where if you get to make payment out, you record in the cash account, or when you receive money, you put it. So no money was paid, no money was received, so forget about the cash account for now. So what happened rather? Two things happened. Number one, the business made purchases, which is an expense, and that's coming to the purchase account, okay? And now the business has created a liability for itself. Very simple. We made a purchase, which is an expense, and at the same time, we are now owing Ben a sum of money. So what you do is that you have to keep the record of an account of Ben so that you can tell at the end of the month or year how much we are owing Ben. So you create Ben account and also what? Purchases account. Let us not forget, purchase will always remain, purchase will always remain what? Will always remain an expense. And expense falls under a debit. So you always debit your expense, then come here and debit your purchases. That is 800 from who? From Ben. Simple. And now if you look at the 800 here, I want to tell you something for those that are learning accounting for the first time. You see, when you post two figures on the same side, it means something. And when you post them on the opposite side, it means another thing. You see, all these accounts you are seeing, they are means of communication in accounting. They are accounting languages. Okay. So if I post a figure on the debit side and I post another figure on the same side, what I am saying is that at the end of the day, these two figures must be added together. So that means we have made more purchases. The first time we made purchase of 500, and now we made another purchase of credit of 800. So the total purchases we have made today now is $1,300. So I have always told you, the only thing you have to try to do always when you are journalizing or doing your ledger account or trial balance or whatever topic you are dealing with in accounting is focus first on getting your first leg, your first entry correctly. That should be your primary focus. So the first entry here is then $800 inside the purchase account. So you have the debit entry already. Then what do you do from here? You create a corresponding credit entry inside Ben account. So you just find Ben account, come here and say $800 coming from where? Purchases account. Simple. Another way to post into this account is ask yourself, who is Ben to your business? Who is Ben? Ben is a creditor. Ben is a payable account. Ben is a liability account because the business is owing Ben the goods have been purchased. So you identify Ben as a liability account. Go once more to your model. What does it say? It says P on the credit side. So anything that is payment, income, liabilities won't be posted on the credit side. The reason you have your 800 on the credit side already. So I can always use different ways to post into my journal, into my ledger, and they will always be correct. So let's move further. The next transaction is cash sales. Cash sales. The meaning of cash sales is, we have two kinds of sales. We have cash sales and we have credit sales. Cash sales means you are selling your goods and at the same time, immediately you are collecting your money. That is what we like to call in this part of the world cash and carry. So you give me money for the goods, I release the goods to you. So in the case of cash sales, you are selling goods and collecting cash immediately. So if that happens, what do you do? Very simple. It's obvious. Cash is involved in this transaction now. So two things have happened. There is receipt of cash, and two, there is a sale. So the two entries will go to sales account and cash account. Simple. Then start with the cash account and ask yourself, what has happened? What has taken place in the cash account? I sold goods, then because of selling the goods, I received money. So if you receive money, you call that receipt. There is a receipt of cash. And the rule says that receipt must always fall on the debit. So you come in and say, I got how much? $1,500. From what? From sales. Simple. You have your debit entry here in a cash account. There must be what? A corresponding credit entry, which will land in the sales account. You already got it. You already got it. So simple. So simple. So you have your debit entry in the sales account. You cannot go and have another debit entry. That becomes an error in accounting, which is what we are going to deal with over time in a topic that we call correction of errors and suspense accounting. That's one topic that a lot of accounting students like to run away from. Okay, so you have this on the debit side. There will now be a corresponding credit entry on the credit side of this account. And that is coming from where? It's coming from cash account. Simple.